Marc, you've been very active in terms of corporate activity recently, and this is another big deal. It's obviously been in the pipeline. There have been SENS announcements, and you've talked about the conditions for it. What does it mean for Redefine, and what does it mean for the assets that you now will have?
Well, first of all, David, where we are in the process is we are now in control of the management company. Just recently had a meeting with the board so we can proceed with the due diligence investigation into the affairs of the fund, and once we've completed that, we'll be able to formalize an offer to shareholders. But in the interim, a number of things have happened. One of the most interesting is the imminent introduction of REIT legislation, which is scheduled for January next year, and that changes the whole capital gain tax structure, so we might well be waiting for that before we make the offer. But whenever we do make the offer, and assuming we do, what it does for the company is it takes us out of our indirect stake in retail and replaces it with a direct stake. So it's about a 12 billion rand acquisition, and we'll be selling about 5 billion rands worth of high props. It takes our mix of properties to 50% retail, 35% offices, and 15% industrial, from where retail is currently about 35% and offices are 50%. So it changes the whole structure of the company. It gives us large, meaty assets, which is where we want to be, good quality assets. And again, it's part of our process of realigning and readjusting our portfolio.
Paint us a bit of a picture of what the Fountainhead assets look like. You've talked about them in broad sectoral property terms. But
okay, so the biggest single asset is Centurion Mall, which is about 3.3 billion of the 10 billion odd. Then you have the newly renovated Blue Route in Cape Town. You have Benmore Gardens in Johannesburg, Bryanston Shopping Centre, which is currently undergoing a refurbishment, N1 City in Cape Town, Kenilworth Centre in Cape Town, then some really nice office blocks. And then on the other side of the coin, you've got about 600 or 700 million of very small industrial assets, which we would clean up.
This also, if you remember some time ago, we talked about your repositioning, getting away from some of the more rural areas where you felt the service delivery wasn't on. A lot of those names you've just mentioned are fairly upmarket suburbs, upmarket malls.
Correct.
And also I get the impression, maybe this is just a perception I've picked up, is that there's a lot of redevelopment of some of these big shopping centres going on at the moment simultaneously.
Correct, that is the point. And part of our due diligence to say how much CapEx needs to be spent on them, how much is incremental in terms of earning and how much is defensive. So we need to ascertain that before we can finalise pricing.
And the retail sector generally, what's your outlook there? There's divided opinion on retail and the consumer, how stressed they are.
I think it's quite interesting because I was looking at some figures last week in terms of high props malls. So a centre like Canal Walk is doing very well. So I think it's the same story. The bigger centres, foot traffic is up marginally, spend per head is up. The smaller centres are taking the pain. I think people are shopping less often, but for some reason the money's still there, and I think you only have to look at most of our retailers, forget about quarters, but year-on-year growth, 12, 14, 15, 18%. It never ceases to amaze me.
The resilient South African consumer just keeps running. Thanks, Marc. That was Redefine CEO Marc Wainer.